Blockworks is hosting its Digital Asset Summit in October. Over 800 institutions are attending, including FTX, UBS, Morgan Stanley, Coinbase, and the London Stock Exchange. To get a discount, use code GUIDANCE250, all caps GUIDANCE250. I am joined by Joseph Wang, the Fed guy, as well as our special guest, Daniel Neilson, who is a monetary economist and the principal of Neilson Macro Advisors. Dan is the author of Minsky from Polity Books, and his newsletter is called Soon Parted. Gentlemen, welcome to Forward Guidance.
Thank you. Thanks for having me.
Hey, Jack. Great to be back. Great to meet you, Daniel.
You too, Joseph.
Joseph, the last time you were here was, I believe, 3 days before Jackson Hole. And you said something like, Jack, I may have pivoted. I think that what I see from the Fed is perhaps a little bit cowardly, is a word that you use. And you said that the Fed essentially is weak, that they're already were talking about that they might have to pivot in the minutes, and that perhaps Jay Powell is Arthur Burns. 3 days later, we had Fed Chair Jay Powell speak at Jackson Hole, where he was talking about how a labor market softening would be necessary to curb inflation, widely seen as interpreted as a higher unemployment rate, and talking about how everyone has to take the pain. So, Joseph, my first question for you is: Jay Powell talking about pain. Was he hawkish enough to convince you that he is not Arthur Burns? Have you changed your mind, or are you still on the fence?
Well, Jack, I think that Powell did a great performance on Jackson Hole. He was very hawkish, as you mentioned. His speech was short and sweet. And I think he did what he had to do, and that is to convince everyone that they're taking inflation seriously. Now, this is important from a monetary policy implementation aspect, because a lot of what happens in the markets, it gets priced in by what the markets think the Fed will do. So if you remember, a few weeks ago at least, some people in the markets, based on implied pricing, were thinking that, maybe Powell would chicken out. Maybe next year they would start to cut rates. Now, it was very important for monetary policy to work to have that pricing out of the markets. And so Powell did what he had to do. He did some open jaw operations, and it wasn't just him. Over the past few weeks, we'd have lots of people from the FOMC come out and basically give the same message. So in that sense, I don't think Powell added anything new. He just basically reiterated what the team was saying over the past few weeks. Markets seem to be more convinced. But for myself, I think that we'll just have to wait and see. Right now, it's been really easy. I think everyone on the FOMC is on board of getting into 3.5% to 4% by the end of the year. The real test will come next year when we're at 3.5% and 4%, and maybe we have some softening economic conditions. What are they going to do now? Now, you mentioned really well that on the minutes, as I noted last time, even though we were still, fairly low in interest rates, 2.5, inflation was high, unemployment was low. In the minutes, we saw that many people on the FOMC were actually concerned of over tightening, and I interpret that to be a weak FOMC. And I don't know if a lot will change between now and next year. So we don't, in my view, we won't really know until they're put to the test, and the test is sometime early next year. So right now, I'll give the FOMC the benefit of the doubt, but the real test comes in the coming months. I don't know, Dan, what do you think?
I broadly agree with your assessment of Jackson Hole, of Powell's speech, Joseph, from Jackson Hole last week. I think central bankers usually don't want to surprise markets. Sometimes a surprise can be good. Right now, they don't want to surprise markets. They want to steer markets in the right direction. They signal. The minutes are a very carefully crafted document that sends very specific messages. Powell was on message, absolutely. As you said, short speech. It's got to be short when you're trying to send a simple message. The simple message was that the yield curve needs to bend up, I thought, and so far that was successful. Rates are overnight rates. The Fed can put them exactly where it wants them, 99 days out of 100 or more. Rates farther out, 2-year and 10-year rate, it's got to talk through the markets, and Powell was heard. Powell was heard when he sent that message. So I think successful from the point of view of what he went into that speech trying to accomplish. I think probably more or less he did.
Yes, and the mechanism by which the Federal Reserve controls near-term forward rates, that is forward guidance, the name of this podcast, and that's sort of hard forward guidance where in March of this year, he said, we're going to be really hawkish. We're going to be really, really hawkish. And the markets got the message and forward interest rates went up. People have been talking about the quote death of forward guidance, heaven forbid this podcast. But how do you
gonna have to change and have to get a new name now?
Yeah. Joseph, why do people talk about forward guidance? Because it's just forward guidance by a different name. Instead of being explicit, he is just sort of sending out vibes. It's sort of soft forward guidance. And also, Joseph, can you comment on the yield curve that Dan mentioned changed, where the 2-year reached a new year high? I actually don't think a high that had not seen since 2007. And now the 75 basis point hike is priced in at 75 basis point. That percentage shot up. And so a double hike is looking not likely, and a triple hike is looking increasingly likely. And it's looking like it's going to be 3.75% by December, which is pretty close to where your target's been the whole year. So has the yield curve gotten the message? And then also, do you have a comment on the mechanism that the Federal Reserve's use to sort of manipulate the yield curve?
I think that the 2-year yields going higher is a mark of Powell being successful in his communication. That's what he wanted the market to price in, right? He wanted the market to get the picture that they're not going to be cutting rates next year. And it's possible that rates would be higher than the market expects. So that's, in my view, very successful communication. Now, the longer dated yield has not moved as much. And when we think about the longer dated yields, a lot of that is supply and demand. So as we all know, we have QT kicking off in full force this year and this month. And so maybe in the coming months, as we have more supply in longer dated treasuries hitting the markets, maybe that will react as well. Now, to be clear, this dynamic doesn't always play out like that. It's kind of hard to predict beforehand how QT reacts. My own view is that as we increase the supply of treasuries, both because the primary deficit is very high and because of QT, we're likely to get more upward pressure in yields. And this is happening at a time when both treasury market liquidity is pretty poor. And also, there is some concern in the markets that maybe inflation expectations, so maybe unanchoring. So I'm just speaking in economist speak. There's Neil Kashkari recently had a podcast, and he was actually noting that was not his base case, but there is some concern from him in the market that maybe the inflation dynamics going forward are not the same as it was before. And if that's the case, then there's going to be potentially a fundamental reevaluation of where monetary policy should be, and that means much higher yields, maybe suddenly.
The Powell speech got a lot of attention, obviously, and rightly so, from Jackson Hole. But they had a multi-day conference with a lot of top speakers, really some of whom really got into the weeds on economic theory. And it's a little tough to read, honestly. No matter how many times you do it, it just takes time to go through all this stuff. But if you try to navigate through, especially the PhD economists in official positions, I'm thinking of Geeta Gopinath in particular of the IMF. This concern about unanchoring expectations is woven through over and over in Gopinath's speech and Karsten's speech from the BIS. That's a really big concern for them, and I think it's very hard to put your finger on exactly what they mean. It's hard. It would be hard to measure when expectations became unanchored, quote unquote. But I do think it's a scenario that has a lot of resonance in economic theory, and it makes the institutional operators in these places very, very anxious, because it's the basis of their mandate is to control inflation. Whether that's possible or not, that's still their job. And so now they're in a situation where they really have to prove that they can do their job when push comes to shove. And they don't express it in a direct way necessarily, but it's there over and over as a concern which underlies the whole central banking world in every country right now, and very present at Jackson Hole. And Powell is thinking about that as well. So he really feels like he's got to step on control price growth, act and talk in a way that really sends strong messages, because central bank independence is, at least in the back of his mind, is what could be lost if that fails.
Hey, Dan, you mentioned the importance of inflation expectations, and that's obviously extremely important for in the field of economics and just macroeconomics profession. So, being a professor in a macro, can you explain to the audience how that works? Why is it so important that inflation expectations are anchored?
Sure. Well, let me say, first of all, that I will try to answer that question, but while we're doing that, we're in the world of academic economics, which is an important world. It's important because it's the way that central banks think, and it drives what they do. It is not always the best description of how the actual world actually works, but people in important positions use that tool to understand the world, so we should understand it too, whether we think it's the best thing to do or not, in terms of understanding what's going to happen. Inflation expectations, the idea is that when I think about, let's say, as an employee of a business, I think about what income I need to afford the life that I want. I have to think about how much stuff costs in order for that to make sense. To evaluate a wage or salary offer, I need to know what my expenses are going to be. If prices are rising quickly, and I expect them to continue to rise quickly, so we're seeing close to 10% inflation in the US right now, similar in other rich countries. If I expect that to continue next year and the year after that, then when I think about the salary that I need, I got to ask for more, because I know that my expenses are going to be 10% higher and another 10% higher the year after that. That's what I believe. And so that makes me want to ask for more wage, but higher compensation costs, that's an expense for businesses, and therefore they have to charge more for their products or services in order to pay for that higher compensation cost. So now if businesses start to believe that the costs are going to rise for them next year 10%, the year after that another 10%, then they start embedding price rises into their own costs. And that can become a self-fulfilling hypothesis.
Now, yes, and Fed Chair Jay Powell referenced this explicitly when he quoted Paul Volcker, and the quote from Volcker in 1979 was, "Inflation feeds in part on itself, so part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations."
Exactly, and Volcker did that at a quite high cost in the U.S. A big recession, a lot of unemployment. Interest rates were high, very high, and stayed high. It slowed down economic activity, cost a lot of people their jobs. It was, it determined the course of the 80s in important ways, the Volcker recession. And for the next several decades, inflation in the U.S. was almost always between 0 and 5%, until last year. So you have to go back to Volcker, and central bankers are finding ways to replay that script right now. You can see it, in whatever every one of those speeches, they make some kind of overture to Volcker's legacy.
They do make overtures to Volcker's legacy, and they definitely are, central bankers, particularly Jay Powell, much more hawkish than anybody at the Fed over the past decade after the great financial crisis. However, I was going over some of Volcker's speeches from 1980, 1981. I have to say, Jay Powell's nowhere close to a true Volcker moment. Volcker was doing things. He was not doing forward guidance. He was basically trying to constrain the money supply. First of all, he redefined what money was, because he said the monetary aggregates that we have heretofore targeted are actually inappropriate. He was lambasting the government. He would go before Congress and said, we have a fiscal policy that is irresponsible and is in charge of inflation. I mean, the equivalent of that would be Jay Powell calling out President Biden and saying student loan forgiveness is not making my job any easier, which, now that is totally verboten. But Joseph, Powell has much farther to go before he becomes Volcker. Would you agree?
I agree with you completely. I don't see Powell going to Congress and telling them to be more fiscally responsible. In fact, whenever he's asked to comment during his hearings, he's always like, I'm going to stay in my own lane. Except, of course, when it was during the pandemic, And he was very loudly for large fiscal spending, and we all saw how that turned out. So it would be good, at least, if you could go and at least gently mention that you guys are not helping me.
So Daniel, you referenced some academic works that were published by central bankers at Jackson Hole. To be honest, I haven't read them. I definitely should. I've got to do my homework. But Joseph, I know there was one paper and one speaker that you paid special attention to, Isabelle Schnabel from the European Central Bank. Who is she? What were her comments, and why did you find them so significant?
So Isabel is one of the top people at the ECB, and her views are, of course, very paid attention to by the markets. And she was mentioning a number of things, actually. One of the things I thought was interesting was she suggested that, what if we're in this different regime in inflation where, for example, a lot of the things that we had in the past, like cheap energy, like globalization, what if that's going away? So that, I think, was really interesting, because if we have this new structural change in the world, that has implications for monetary policy. And of course, she also emphasized how determined she was to get inflation under control. And again, that's in line with what the central banking community, including Powell and the BIS, have been talking about. So as Dan mentioned, they perceive things like expectations to be important. And it's really, really important to get ahead of that, because what they've learned from the 70s is that if you let inflation get out of control, it's going to be even more painful later to get it back into its box.
And just to put things in context, while inflation in the US is red hot, the Federal Reserve has hiked rates. Perhaps some people say it's not enough, but they have gone from 0 to 225 basis points, so 2.25%. And the forward curve is suggesting that it gets as high as essentially really close to 4%. We're recording this just before noon on Wednesday, August 31st. So that's something. You're half of the way there. If inflation's at 8%, you go to 4%, you're half of the way there. The ECB, meanwhile, inflation's at 9.1% in the euro area, and their interest rates are at 0%. Dan, you are an expert on European central banking. Like Joseph, you're an expert in the plumbing, but your reach is global, not just on the Federal Reserve. Why are interest rates at 0? And then also, so that's the interest rate channel. And then also, what's going on with the European central bank's balance sheet? And the Fed, we're reducing. The Fed, I say we. I'm not part of the Fed, but in the Fed, the Federal Reserve's balance sheet is shrinking. What's going on with the European balance sheet? So, but first, comment on the rates, please.
Sure. The ECB is a little bit behind the US in terms of timeline. I'm not making a judgment about about the appropriateness of their policy. They're in a different, they have different concerns. They have a different legacy of policy. They talk about things differently. Their political economic situation is different. In any case, they're raising rates. Their path of raising interest rates has been later and not quite as fast in if you count up the basis points, not as fast as the Fed. In a sense, they had more accommodative policy, previously, even dipping down to negative short-term rates. They are on a tightening path now that is quite certain. There's an ongoing debate in the ECB about whether to raise aggressively, follow the Fed's lead with half point or even 3/4 point rate rises. There's a camp. Is it a camp? There's a thread in the ECB discourse which argues for slower rate rises, slow and steady, 1/4 point, may get to the same level, but just do it one meeting at a time rather than taking big leaps. I've spent a fair time studying the ECB and other big central banks. The important thing I think to say is that we're in a global dollar-based system. And so the Fed is still the one that sets the pace for everybody else. And the ECB is responsible for monetary policy and financial governance in a big area, rich area, lots of capital flows, big geographic area, subordinate to the US in the sense of we have a global dollar-based system, and every central banker in the ECB will not disagree no central banker would disagree with that. But the euro also stands on its own to a greater extent than a lot of other currencies. So it's still a dollar-based system, but in bigger, richer countries, Japan, I would put in this category as well. They do have some ability to make independent monetary policy. That's not so true for other countries farther down the monetary hierarchy.
Yeah, just to put it in context, so when the Federal Reserve raises interest rates, that puts pressure on other central banks because foreign currencies will depreciate because money will flow to the dollar, where now they're getting 2.25% instead of 0%. So, for example, the Bank of Brazil raised interest rates to 13%, perhaps higher now. The Bank of Ghana raised interest rates to above 20%. But, Dan, you say that the ECB is still within the dollar system, but they have some independence. I mean, the ECB is at zero, and they're really, the ECB and Japan are extremely behind the curve. And that's why when folks talks about the US dollar index, the DXY, it's mostly the euro and Japan, which are, their currencies and financial system is governed by central banks that are extremely dovish relative to the Federal Reserve. So let's talk about the balance sheet. And sure. Dan, you got a piece on your blog, which is excellent, soon parted, about it's called anti-fragmentation, and it's not just about the size of the ECB balance sheet, but also its composition and the securities that the government securities, what countries they come from. So tell us about that?
Sure. The ECB operates a big balance sheet comparable in size, similar scale to the Fed's balance sheet. They govern a monetary area that is made up of different sovereign countries. So the ECB is comparable to the Fed, but in the Fed, we have the U.S. has a single monetary system, but the states don't really have a lot of political independence. In Europe, that's not true. You've got France and Germany, Italy, Spain, these countries with a considerable amount of, they have their own political systems, their own governance. So the ECB is trying to hold together this monetary system in places with a complex in a place with a complex internal politics. They've been buying securities like other central banks. The ECB has been buying securities since the global financial crisis. They've expanded their balance sheet enormously. Like in other places, that is now leveling out. What we found since this is a recurring theme, but people have been worrying about it since at least the beginning of the summer, that there's been an increasing divergence in the rate paid by different European sovereign borrowers. So the main thing that people worry about is the interest rate paid by the Italian government on their debt, especially 10-year debt is a place where people measure that. The rate paid by the Italian government on 10-year bonds versus the rate paid by the German government on 10-year bonds. And that spread measures, in a sense, the credit risk, you might say, between lending to the Italian government versus lending to the German government. From the ECB's point of view, that's a measure of what they call fragmentation, because it says that credit conditions are different in different parts of the Eurozone, but a monetary union is supposed to have the same credit conditions, or close to the same credit conditions all across the union, by which I mean the Eurozone, not identical to the European Union, of course, but the European Monetary Union, the Eurozone. So the ECB worries that if interest rates are high in Italy, then that means that the union is not holding together as closely as it should. So what we've seen in just the last couple months is that with this big bond portfolio, right, there's constant flows as some of those bonds get repaid, and the ECB can choose whether to roll over the proceeds by buying new bonds. And what has just started to happen basically since June in this graph that you're showing, there's a lot of information on there, but the basic story is that the ECB had been buying bonds from all over the Eurozone, from all the different European sovereign borrowers. And just in the last 2 months, they've changed policies, and now you can see the net flows for German bonds have become negative, meaning they're allowing holdings of German sovereign debt to run off, and they're using the proceeds to buy other sovereign debt. In particular, Italian is the one that shows up most clearly in the graph. So this is a way to try to bring those interest rates back together, to bring the spread between Italian and German bonds down. And so from the ECB's point of view, that's an anti-fragmentation tool. Interesting, because they did this using existing rules. At the same time, they announced a more comprehensive policy, anti-fragmentation policy. But even while they were doing that, they started doing this transaction using the authority that they already have. And what its effects are going to be, I think we'll have to see. But the flows are the change in policy is pretty significant, as you can see in the graph, and the flows are not small. And soon we'll have August data, and maybe the flows got even bigger.
There's a good chart that Dan has in his post that highlights this point. I think that highlights Dan's point really well. You can see that the flows into the Eurozone bond market, there's less to Germany and a lot more going to Italy and Spain, right? So to Dan's point, the ECB is trying to compress that spread. So the ECB, unlike the Fed, has this other aspect to their monetary policy transmission, where when they hike rates, sometimes it doesn't flow to the different sovereigns at the same rate. Sometimes it doesn't flow to Spain and Italy as well. And so you'll see that that spread, as Dan mentioned, between Italian debt and German bonds widens. And they're trying to close that. And you can see it in that purchase flow that's in Dan's blog post.
Yeah, and Dan, you said the word credit risk, and some people listening may have said, did he mean credit risk? But you actually were correct, because in the US Treasury, essentially, when you buy a Treasury, a 10-year note, 2-year note, whatever, from the Treasury, there's essentially no credit risk because the US government can print as much money as it wants to pay you back. It is a monetary sovereign. Italy is not. Italy cannot print euros. So they essentially are similar to a company who's borrowing dollars via bonds. They're just a company borrowing euros via bonds. So there is a risk of a default, and they could do some sort of restructuring and the like.
Or they could just leave the Eurozone. And so there's that redenomination risk as well.
Oh, yeah. Good point.
Yeah, we can summarize all that as credit risk. If push came to shove, and we were actually talking about exit of Italy from the Eurozone, which I don't think is likely, let me be clear, or from Spain. Neither of those things are likely to happen. It would be messy. And so it wouldn't just be a default. It would be an extremely complicated legal process, where the nature of European sovereign debt would have to get litigated, and we would be able to talk about it for months and months and months at a time. That's not happening. But what is happening is that people ask for a little bit of a spread for Italian debt over German debt, because this possibility is out there somewhere on the horizon, and so it costs more for the Italian government to borrow than Germany.
And does the fact that the ECB does not want to have Italian spreads, bond spreads widen significantly, does that take primacy over the ECB's mandate to fight inflation? Because, in the US, the Federal Reserve is shrinking its holdings, it's shrinking its balance sheet in order to fight inflation. We can have a talk about how effective that actually is in combating inflation. But in Europe, what is actually happening to the balance sheet itself? Is the total number of the balance sheet, is that still increasing? Is it going down, or is it flatlining?
It's basically flatlining. Definitely these sovereign debt purchases, the two graphs farther up in this post that you already showed, both show that these two different asset purchase programs, which are called PEP and PSPP, you can see the post for the details, that both of those purchase programs have been stopped and are in runoff, kind of in stasis. So the total balance is stable now, but that means they have to reinvest, any proceeds that come in have to be reinvested. So the overall level is staying the same. And I think that's true of the whole balance sheet for the ECB, more or less. The whole level staying the same, but what they're doing is rotating the contents of that portfolio as it rolls over away from holding German debt and towards holding Spanish and Italian debt. To summarize. So that's, there's some political economic consequences for that. Now that this piece of information is out in the world, it makes certain people who have a certain feeling about German debt, angry that the ECB would sell German debt and buy Italian debt, right? And those are the political fissures which are at the absolute heart of the ECB. That's why Germany plays a special role in the ECB, and that's the thing that people are always arguing about if you dig away all of the other layers. We'll see. I don't forecast I don't forecast like Eurozone breakdown or anything like that, but they're having to work to hold it together.
Thanks, Dan. Moving back across the pond, you have another excellent chart on soon parted that I'm going to need both of your help in understanding.
Okay.
It is of the various interest rates that financial parties pay. When people say the Fed is hiking rates or interest rates have collapsed, there's not just one rate. There's the Fed funds rate, and there are so many different rates. Dan, we're looking at this chart. What are we seeing here, and why is it significant?
Right. Let me take first crack. I'm glad you like this chart. This one is definitely information dense. So if you're not used to looking at this kind of thing, it might take a minute. But let me see what I can do as far as an explanation. This is a graph of short-term interest rates. All of these rates are overnight US dollar interest rates. So these are measures of the cost of overnight money at the absolute heart of the global dollar system, overnight money markets, more or less in New York. Every rate here is measured as a spread above, and sometimes it's negative, so a spread relative to the rate that the Fed pays at the overnight reverse repo facility. So that rate should function more or less as a floor, because you can always deposit funds at the Fed and get the overnight repo rate, the overnight repo facility rate. So people in general should not accept a lower interest rate than that on any money that they have. They can always go to the Fed and get the overnight repo rate. So that rate is at 0. Remember, that rate is changing over time during this period, right? We've been raising that rate. It moves together with the Fed funds target. It's a constant spread. So it's a flat line here at 0 in this graph, but the actual number has been changing. What I'm showing here is spreads relative to that number. So what you can see is that there's a bunch of different overnight interest rates. They move together more than not. They tend to move as a group. There's also spreads between them. At certain times, the spreads remain constant. At certain times, the spreads widen and narrow. What we learned in the global financial crisis of 2008, some of us learned it then, some of us knew it already before that. You have to watch these spreads to understand what's going on in the monetary plumbing. And when these rates that normally move together, each one of which measures the price on billions or even trillions of dollars worth of daily flows in the money markets, right? So if those prices are normally very similar, that means, that Fed funds versus overnight repo is not much difference in the money markets. That means things are working well. And when the spreads open wide, that means one thing or another thing has suddenly gotten super expensive. And that can be a sign that something is beginning to break down.
So then it looks like it's the spreads are widening a bit, right? Yeah. It seems like after we hit that below 0, things begin to widen, as if the transmission policy is a little bit more fragmented now. Yep,
that's what I see too. There was a period, so this is May 2020 up to a few weeks ago. You can see all through 2020, 2021, rates are clustered in the middle. And they're tending sort of towards the top. To me, that picture is pushing up within the range. And that really changed after the beginning of 2021. And so I call this leaky floor because I think the Fed is trying to provide a floor using the overnight repo facility. But you can see that it is not completely successful. And there are a couple of repo rates in particular that have repeatedly printed below the floor. How much should we worry about this? Joseph's question just now, is this some kind of breakdown in transmission? I think that the answer to that question is definitely yes, that it is a breakdown in transmission. Should we worry about it? I can't tell yet. I don't see a lot of people talking about this picture, and that could be because they believe that this system can handle this level of fluctuation and will correct itself before too long. That could be right. I'm not certain, but I think those spreads are getting abnormally large. They after this graph was printed, they collapsed a little bit back towards 0 and then have started to expand again with a lot of negative spreads on short-term rates relative to the overnight repo. So this state of affairs is ongoing.
Right. So for folks who are listening to this as a podcast, I apologize and I appreciate your patience. This is not a chart that you can just see in your head like the S&P 500. This is a very complicated chart. So perhaps it would be good to watch it on YouTube. But I'm just going to explain what I understand, and then I'm going to give the reins to you, Joseph, when I lose control. So the green and blue lines that are flat lines that do not wiggle, that is the Fed. That is controlled by the Federal Reserve. And that is a target range of the federal funds rate, which is what the Fed targets, with the green line being the lower bound and the blue line being the upper bound. So now when we say the Fed is going to hike 75 basis points, we mean it's going to raise its range from 225 to 250 to 325. And then in the orange, we have a Fed funds effective rate, and you see it squiggle a little bit, but not that much. Why? Because it's kind of a dead market, as you pointed out. And now the real action is in the repo market. And that is where we see the extremely squiggly lines. And that, Joseph, is where I'll hand it over to you. So what is the turquoise line, the GCF Treasury repo, as well as the tri-party, and exactly explain why it's significant as well that it's gone below this channel.
Like Dan mentioned, it seems like when rates get really low, the ONRP doesn't function as well as a floor. It's a leaky floor, as Dan mentioned. And that probably has to do with the fact that not everyone has access to the ONRP. Only select counterparties do, mostly money market mutual funds. So if you're a money market mutual fund, you can always just deposit money at the Fed. But if you're not, then, well, what are you going to do, right? If someone offers you a rate that's below the ONRP, well, maybe that's better than nothing. So you can have, like Dan mentioned, a leaky floor, and it looks like it's getting increasingly leaky. We'll have to figure out to see if QT will tighten things up a bit, or maybe if we have more bill issuance later on.
Yeah, exactly. I think this is the graph that I watch, and most of this is daily data, so you can watch it every day. This is the graph that I watch, and I suspect that a change in monetary conditions is going to show up first somehow in this picture. I think the fact that all these rates are at or below the floor is an indication that the Fed is that monetary conditions are loose, that there's money flowing around here with nowhere to go, and people are accepting low interest rates on their money because there's nowhere else to put it. And when things start to change in the financial system, one of the first things we're going to see is that the pattern of this collection of short-term rates is going to move up off the floor and start behaving differently. A good outcome for the Fed would be that it does that in a smooth and orderly way. Things start to drift slowly back up to the middle of the range, and then they stay there in a nice orderly picture. Even in 2020, 2021, early in the pandemic, a lot of things were a mess. But money markets weren't a mess, for the most part during that time. And I think that this picture shows that. So that would be a good outcome for the Fed. A bad outcome for the Fed would be that they somehow lose control of some of these rates, and they have to work a little bit harder to keep money markets working.
So I have very little confidence in my ability to understand this. So if folks are listening to this and they feel like it's complicated and they don't understand it, don't worry. I feel the exact same way. So repo is overnight or short-term lending of securities. So if I want to repo my security, I essentially sell my treasury to you, Joseph. You buy it, and then I'm going to buy it back from you at a later date. So it's essentially a loan. And the Federal Reserve's reverse repo facility is where select institutions can deposit their excess reserves and get a return. So in a sense, they are, quote, lending to the Fed. I know the word lend is kind of a word fraught with some contradictions and nuance that maybe we'll get into. But the real squiggly line that is out of control, I believe it is the tri-party general collateral line. So at its lowest level, it's 20 basis points lower, meaning that folks would actually lend, quote, lend money at negative 20 basis points relative to the reverse repo. So why would that make sense? If Joseph, if your bank is paying me 1% on deposits, and Daniel, your deposit is giving me 80 basis points, 20 points lower, why would I ever go to you, Dan? Why would that make sense?
Right. Well, Joseph mentioned earlier, one possibility is is differential access to the Fed's facilities. So the Fed offers this overnight repo facility. I think of it as a deposit facility, which makes a little bit more sense than a lending facility, or than a borrowing facility. You know, the Fed is accepting deposits, just acting like a bank, taking in cash as through the repo market. And in repo, it's, as you said, secured. So the counterparty gets gets access to a Treasury security to hold as collateral. So not everybody can use that facility. It's intended for money market funds, just like the reserve balances are a deposit facility for the commercial banking system, and only certain banks can access them. If you're somebody else, you might still have a bunch of cash to put somewhere, and if you had access to the Fed, then you could just put it at the overnight repo facility and get that rate. But since you can't, you might have to accept a lower rate from someone else.
Just on Dan's point, so these money market mutual funds that have access to the Fed, they charge a management fee, an asset management fee. So if you are an investor, who doesn't have access to the Fed, you can either give your money to the money market fund to invest at the Fed, and they'll give you a return minus their fee, or you can just accept a rate that's lower than the RRP. So you probably have to compare. Just to make this more concrete, what if the RRP right now is 1%, just hypothetically? Then if I don't have access to the RRP, what are my options? Well, I can give money to a money market fund who will turn it around and deposit it for 1% at the Fed, and then maybe charge me 20 basis points, maybe charge me 50 basis points. So the best that I can get would be, let's say, 0.8%. If they're charging 20 basis points. So in theory, I would be willing to accept an investment in the private market that is higher than 0.8%. It's not as good as the RRP, but it's better than the RRP after fees.
Right. And Joseph, what is the difference between the tri-party general collateral and the general collateral Treasury repo?
Yeah, so as Daniel mentioned in his post, I think the repo market is segmented. He has a pretty good description in his post. I'll let him explain the different repo markets between tri-party and GCF and so forth.
Sure. Well, look, this stuff is better understood through reading. So I'll plug my newsletter, which is called Soon Parted, one more time. Tri-party repo this is the big one, right? This is where the Fed is doing overnight repo. All of that flow goes through the tri-party repo. So there's some overlap in these different rates that are shown here. They're not completely distinct from one another, Tri-party repo, is the biggest repo market. There's a lot of Treasury collateral. There's a few other things happening in tri-party repo. And there's a large number of both lenders and borrowers. A lot of institutions of different kinds meet at the tri-party repo market. There are a couple of different subsegments which serve slightly more specific purposes within the repo market. One of which really matters for this picture, right? The biggest spikes down are actually in the DVP repo. This is DVP is delivery versus payment. And it's a specific facility offered by the DTCC, big securities clearing infrastructure, that allows people to get access to specific collateral in the Treasury market. So this is interesting. Mm-hmm. What is basically happening is that people are going to this market not to deposit money, but actually because they're looking for the collateral that they get back for their deposit. So they're going to put in some cash and they're going to get back a Treasury security. And they're not actually looking for a place to deposit money. They're looking to get the security because they've sold those securities. They turn around, they obtain the security as collateral through the repo market, and they sell it to somebody else, and they're waiting for the price to fall. When it falls, they're going to buy it back and they're going to return the collateral. In the meantime, they have outstanding repo borrowing. And so what does that mean? It means two things. One, that they're willing to pay at least 20 basis points on certain occasions to hold on to their bet that bond prices are going to fall. They're willing to pay a significant overnight cost of carry for these transactions because they're confident in their short positions. They think bond prices have to fall. And that means that some of these spikes, one possible explanation for these downward spikes in overnight rates is connected to other maturities farther out on the yield curve, where this bet is more or less betting on farther parts of the yield curve to rise, meaning the bond prices, not overnight in lending, but 2 or 10 year borrowing, that those interest rates are going to rise. When that happens, those bond prices will fall and those short positions will make money. And this 20 basis point gap would then prove to be a profitable investment. So this is a theory that I have heard. These are my words, but this is based on conversations with people who are in a position to know. But it's not firsthand knowledge. I'm trying to figure it out here. So that's a theory. We'll kind of have to wait and see to find out if we can confirm that theory or not.
Right, Dan. Earlier, I incorrectly said that the red line that was at the bottom of the chart was the tri-party general collateral. You correctly pointed out that it is the DVP overnight repo rate, which allows access to specific securities longer out on the curve, like the 2-year or the 10-year. And it's actually so people can short the bond. There are some folks who say, and there's an element of truth to it, that the fact that repo rates are so low, have collapsed below the floor, it indicates that there's a scramble for collateral because people need the collateral because there's a chaos in the system. And they're sure. But also another way to put it is people want to borrow this collateral because they want to short it because they think it's going down. So not that the collateral is so good, but that it's so bad. In the same way that if you have some like bankrupt stock and you want to short it, it's going to cost you 500% a year annualized not that the 2-year Treasury is by any means like a junk bankrupt stock, but maybe someone listens to Joseph Wang's podcast that we did in December that the Fed rates are going to spike, and they go in their brokerage account, they short a 2-year Treasury future via their broker. How does their broker enter the trade? They have to short it now too. And how do they do that? They have to borrow a 2-year Treasury note. Can they do that via the tri-party thing? No, they have to go specifically hunt that security down and then short it. So is that why? Am I totally off base?
If you're a cash investor and you invest in repo, you could either sometimes it's what you can do at general collateral. What that means is, let's say you invest, you put your cash in and you can receive basically any sort of Treasury security. You don't get to choose. You don't really care. You're really more about investing cash and just want to have some safe collateral. Now, when it's DVP, as Dan mentioned, then you're putting out cash, but what you really want though is a specific security. Maybe you want to short the on the run 2-year, like you mentioned, Jack. So that's the difference between, let's say, the specials market and the GC market. In the specials, which is done in DVP, as Dan mentioned, you specify what security that you want, and that helps push repo rates lower because in order to get that specific security, oftentimes you're willing to accept a lower repo rate. So for example, if the general collateral rate is 1%, then you invest your cash and you're willing to accept any Treasury security and you get a return of 1%. But let's say you want a specific security and you're willing to pay for it. And how do you pay for it? You pay for it by willing to accept a lower repo rate. So for example, let's say I really want that 2-year because I want to short it, as you guys have been talking about. I'm willing to put my cash out and accept a return of just 50 basis points. So that's much lower than the 1% GC rate, but that's okay because I really want the 2-year and I want it because I want to short it. It's not necessarily, as you mentioned, Jack, some kind of collateral shortage. It's maybe because people think the collateral is not priced well and they want to express a market view. And, if you look at Dan's graph, the decline in DVP repo kind of coincides with rates going higher, right? So it makes a lot of sense to think that, when DVP rates are very low relative to the RP, that means there's tremendous demand for specific securities to short.
After I put this graph out, I had a request to mark the dates of the Fed rate hikes. So the next time you see this graph, it has a vertical line each time the Fed raised interest rates, which adds to the information that you're being asked to take in, but it actually makes it make a little bit more sense also.
At the Fed, we actually have a chart like this that we would show, and it's just like this, except yes, it also has the FOMC dates.
That's good enough. That's high praise when you make a chart and someone says, the Fed used to look at this
we actually
chart
do.
Well, before we move on to our final topic, I just want to give a final shout out to you guys' blogs and books. Daniel, people can find your writings at Soon Parted on Substack, and we'll put the articles that we discussed in the description. And then your book is called Minsky, which I want to check out. Joseph, your writings can be found fedguide.com, and your book, of course, Central Banking 101, is a must read. Daniel, let's move on to our final topic, which is tornado cash, which I first heard about sort of from someone in crypto maybe 9 or so months ago, and then I see that it was shut down by the U.S. government. What's going on here in really basic terms? Explain what happened and why it's significant.
Sure. Right. So now we're in crypto world, and which I approach. I'm a curious skeptic. I'm not. I think the questions are interesting. I want to understand what's going on there. I don't believe we're going to rewrite the monetary system overnight, but there's cool ideas there, and I want to understand them. So Tornado Cash. This is a crypto project. You could call it DeFi, decentralized finance application. It's it's code. Basically, so the people who work on this have written a computer program. That computer program executes on the Ethereum blockchain and on other blockchains. It provides a payment service, which is very clever, in fact, and uses very modern cryptography and some pretty smart coding to allow people to make and receive payments anonymously using the Ethereum blockchain and other blockchains. If you know Tor, the internet traffic anonymization service works along a similar principle. The way in very quick terms, the way it works is that you go into the Tornado Cash space, you acquire tokens. The tokens are in fixed denominations. They're decimal fractions of Ethereum, 0.1 Ethereum, 1 Ethereum, 10 Ethereum, Ether, I should say, is the name of the coin. So fixed denominations. So it's like cash in a way that, you can't tell one $10 bill from another $10 bill. It's just like that. Cryptographically, there is a system which hides each person who's putting tokens in. It hides them among all the other ones. You can privately exchange the key to one of these tokens off-chain, offline, on a piece of paper or some other private channel, to someone else who can redeem the coin. And cryptographically, mathematically, it's impossible to connect the person who took the money out with the person who put the money in. So you could observe someone making a Tornado Cash payment, and you could observe someone receiving a Tornado Cash payment, but you couldn't link the two. This is a way to allow anonymous payments. Very clever. It has come under attack recently from the, should I say attack? It's come under scrutiny from U.S. regulators who've said your service is being used by North Korean state organized crime and is being used to launder money. You're unable to comply. The way I read the regulation or the sanction that's been placed against it is you are unable to comply with Know Your Customer and anti-money laundering regulations. Your service is intended to avoid those regulations, but you are providing a financial service. What's interesting is that there's no assets to this service. It only exists as open source code. Their GitHub has been taken down, but the code is still out there. And even more, it's still executing on the Ethereum blockchain. It's there, and there's not really anybody who can just flip it off. So it's raising some big questions about the regulation of crypto and what that means for people who are in that space.
Yeah, so they can't take it down. Are there people who are the CEO, the CFO, people associated with the company where the government can knock on their doors or what? Yeah,
someone's been taken into custody. The guy, it's not a CEO, right? It's not a business. There's no legal entity. It's just a person. And his name is escaping me. I tend to think about what they do, not necessarily the names, but you can look it up. Yeah. It has been taken into custody. Crypto world is up in arms about this. You can understand why, because all this person did was write a computer program, So I see this as a major political economic contest between financial regulators who have the power of the state and who have the authority of law versus code, who I think have probably misjudged the situation, believing themselves to be beyond the reach of those laws. I think we're going to see, in fact, that it's money. It was always money. It's finance. It was always finance. And when push comes to shove, the courts will stand on the side of the regulators. We've regulated money. We, human societies, have regulated money and banking for a long time, and we're not going to stop just because someone figured out how to run a distributed ledger.
So this is basically a truly decentralized kind of anonymizer, basically. Is that right? And
Yep.
It seems like they are having trouble stopping. Well, that has huge implications that I can understand. If the government cannot track people, they would be upset. And not just that, I'm sure they would say that potentially that gives criminals a lot of opportunity, but it also limits the power of the state significantly.
It does. What you're seeing right now, so Tornado Cash, you can't switch it off. They've brought the programmer into custody, but the code still exists. So what you're seeing is most people don't access the blockchain directly. They go through a wallet provider or some kind of account, Coinbase or whatever. And those places do have assets, and they do have businesses, and they do have lawyers, and they are in a position to cut their users off from this service, right? So you can't switch off Tornado Cash, but you can make it so that a large majority of users can't access it through the way that they normally access the crypto world. And those institutions are, in fact, complying by and large with the sanctions, despite the free speech argument that crypto enthusiasts are making. The businesses that are involved in this are saying we're going to follow the rules, which is not a surprise.
Yes, Coinbase is a publicly traded company. They have shareholders. They have stakeholders. They have to comply. I mean, if you're a business, you have to comply with the law. You can't break the law.
Yeah, I think crypto.
You can.
You can try.
Of course you can.
You can try, right? And I think crypto has acted as though there wouldn't be any consequences, right? The whole crypto mindset and the movement. And I'm not against it necessarily, but I think they've acted as though they're free to do whatever they want. And you could see why they would draw that conclusion from the experience of big tech over the last 20 years. Have been able to write their own rules to a significant extent. It's not until recently that they've tried to get into the core of the financial system, the core of the monetary system. That's pretty new. And I think that they're going to find that the regulations bind a little more tightly in that system. How this all plays out in the next couple of years for crypto, I have some opinions, and so far what I've seen from Tornado Cash has not caused me to radically change my opinion. So this makes sense to me. But the details are really up for discussion. We're going to find out. I find it very interesting. I write a lot about crypto, and I'm always trying to understand what is new and how it fits in with what's already there. Crypto, I think the way to critique what they've done is that they have not been sufficiently interested in understanding the system as it already works. They assume that it's simple. They assume that it doesn't work very well. There's some truth to that. But people should spend more time understanding how it actually does work and how it has worked. And that's what I try to add to the conversation. And there are definitely plenty of people who want to be part of that conversation as well. So
right. Well, there are a lot of parallels that if you've studied traditional finance, you would be aware of. So like, I really don't know anything. I know very little about crypto, and I know much less about computer science. Not a computer science person at all. So totally technologically illiterate. However, when I did learn that Terra Luna was unbacked, but then it became backed because it added Bitcoin to its balance sheet. But I instantly thought, okay, well, the time when it's going to need this Bitcoin is going to be a time of stress, and during a time of stress, Bitcoin will have gone down something like 40%, and that's exactly what happened. Like if you're a real estate, if you're a bank, you can't rely on short-term overnight loans to like Lehman Brothers. It's all correlated. So there's a lot of parallels.
Exactly. You should read my book because you've already got the core idea right there. And no, I think you're exactly right.
Guys, I have Daniel's book and it's great. So I highly recommend you read it. And Jack, you're so on point about that. Luna using Bitcoin to back Luna. That makes no sense. That's like having a lot of US dollar debt, but then backhand with like Japanese yen or something like that. There's that currency mismatch that doesn't make any sense. That was totally going to blow up.
It's like, Joseph, you said, Jack, you own Apple stock. What if it goes down? I said, Joseph, I'm diversified. I don't just have Apple. I also have Microsoft and Facebook and Netflix. Don't worry, I'm good. I'm diversified. Yeah, wonderful. Well, gentlemen, it's been an absolute pleasure getting to pick your brains. Joseph, people can find your work again, fedguy.com. On Twitter, you are at fedguy12. Daniel, again, your blog, Soon Parted. Folks should definitely check it out. Daniel, where are you on Twitter?
At DH Neilson. We can put that in the caption.
Yeah, wonderful. All right, well, gentlemen, thanks so much. Would love to do this again.
Thanks very much for having me. Talk to you guys soon. Thanks, Jack. Thanks, Joseph.
Thanks. And guys, remember to follow Jack and listen to Forward Guidance, one of the best macro podcasts on the internet.
Oh, wow. Because of you, Joseph. You're right, but it's
because of us. All right.
Okay,
bye.
There we go. There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.